Okay, in this short video, we're going to talk about short selling. Now, let's imagine an investor who thinks that IBM's current stock price of $100 exceeds its true value, and therefore he agrees to sell at this price even though he doesn't own any shares of the company. Sounds a little strange, doesn't it? How do you sell shares that you don't own? Well, let's assume Bill simply borrows shares from Jennifer, who agrees to give them back to her in a certain agreed upon time period and pays her a fee to do so. Well, what if Bill's right? Now, suppose the price of IBM stock does fall below $100 to, let's say, 95 bucks. Now, how does that help Bill? Well, here's how it works. Remember, Bill already sold the IBM shares at 100 bucks because he thought they were going to fall, and he actually believed that they would fall. Now that the share price actually has dropped to 95 bucks, he can buy the shares that he borrowed from Jennifer and pocket the $5 in difference. Now, of course, he has to pay some small fees and commissions. Now, here's a little closer look. Remember, he sold at 100 bucks. He bought when it fell at 95. He keeps that difference of $5 less commissions and fees. Now, Jennifer gets her stock back, and she gets a small fee to boot. Now, what if Bill is wrong? Now, what if the price of IBM stock actually rises to 105 bucks instead? Now, what does Bill do? Well, he's in big trouble. Bill still has to return the stock to Jennifer, and before the contract term expires, he has to buy the shares at whatever price he can find, even if they were more expensive. So Bill's out $5 plus fees. And the upside risk, if you think about this, is actually much greater than the downside return. Now, why is that? Well, the reason is, on the downside, you can only go from $100 to zero. All right, 100 to 0. That's his greatest upside potential. I say upside potential in the sense that he can only make so much money short trading because the price of the stock can only fall so far. That is, fall to 0, at least theoretically. Now, on the other side, how high can the price go? Well, the sky's the limit. At least theoretically it is. And so that means that while his gains are limited, clearly there's a finite limit to those gains. The losses that he could experience are actually unlimited losses. So, how does short selling actually help the market? I think this is a very valid and important question. The truth is that the short sellers actually help rein in overvaluations of stock. That is, their efforts actually bring the stock prices back to wherever they should be, right? At least according to the shorts. Now, the shorts don't always get it right, not trying to set them up as gods or crystal ball gazers. Sometimes they are wrong, but much of the time they're right. Now, how is this really any different than that of investors who trade long? Well, the truth is it's actually not that much different at all. Those who trade long believe that the current market price is really undervalued and that the fair price for the stock ought to be a lot higher. Their very act of buying the stock actually helps buoy the stock even further. If you kind of take a look at the dot-com bust back in 2000, you can think to yourself, well, what benefit would there have been in limiting or eliminating short selling then? Essentially, many unsuspecting investors would have been just completely bushwhacked had it not been for some short sellers sort of seeing that many of these dot-com companies really were truly overvalued and began shorting them. That already sent the signal to other investors when they saw those short positions going up that it was probably high time to bail out. Now, in the end, the market did crash and crash significantly. We didn't say that short sellers were going to prevent necessarily bad things from happening, but what they can do is just serve to help moderate these swings in the market. Now, what has been sort of the government reaction to these things? Well, there's been a couple of ways of combating short selling. One is the uptick rule. What is that? Well, stocks can only be sold short, only at a price above the previous reported price. I think this is a very strange rule. Notice that there's no rule the other way. There's no uptick rule for long selling positions. And that is, why can't there be a rule that says, well, a stock can only be bought only at a price below, let's say, the previous reported price? Well, that's a little strange, but notice they're not being treated the same. The other thing is capital requirements. The SEC typically requires that brokerage firms keep a lot more capital for short positions than they do for long positions. Now, let's take a look at the facts and where these came from. Essentially, it came from the Great Depression and the 1929 stock market crash. And many folks do blame a great part of the decline in the stock market on excessive short selling. However, the facts don't quite support this conclusion. Even the New York Stock Exchange reported in 1931 that short sales of stock were only about 0.01%. Yes, you're reading that correctly. Not 1%, 0.01%. That's 1/100th of a percentage point. That hardly sounds excessive.